People have been complaining about this for 400 years, and it might surprise you. I mean, how do you even sell something you don't own? The first recorded complaint about short selling was recorded in the early 1600s, and there have been debates about it ever since. Short selling is when a trader sells a stock or a bond at today's price and hopes to buy it back in future at a lower price. Have you ever heard of buy low, sell high? This is kind of the opposite, where the trader is trying to sell high and buy low. Here's the truth about short selling. It's part of every developed market and many emerging markets, and it's likely to only continue to grow. Short selling isn't going away. So the only question is, are you going to benefit from it, or is your competition going to make money that could have been yours? Since a trader is selling something they don't own, they need to borrow it. And that's where securities lending comes in. Institutional investors lend their securities to these traders in return for a fee. People ask me, why would I lend securities to someone who's trying to drive the price down? I hear you. Why would you do that? If you don't do it, someone else will. In any case, short sellers only have a view. They aren't magicians who are always magically right. They have a view, just like you. Hey, remember that when you bought the stock, you were expressing a different view to the seller. Right now, there's about $2 trillion of stocks and bonds that are on loan, and lenders are earning $10 billion a year in fees. Yet only 20% of institutional investors lend their securities today. And they include BlackRock, Vanguard, Fidelity, and many of the world's largest pension funds. If you aren't lending today, ask yourself, what do they know that you don't know? Are you lending your securities today? And if not, why not? Either way, tell me in the comments below.